Some people call this week the Super Bowl of earnings. I'm going to bring you up to speed with the stock market, the macro headlines, as well as several earnings reports. We just had earnings from Microsoft and Google. I'll also cover Meta, Enphase, and several others. I'll provide the highlights as well as my thoughts and analysis. Earlier today, the NASDAQ was down like 2.5%, and it's recovered really nicely towards the end of the day. The sell-off really came down to Meta earnings as well as the macro headlines. So the big one here is GDP growth, 1.6% versus 2.4% estimate. Also, the personal consumption expenditures price index, try to say that 3 times fast. A key inflation variable for the Federal Reserve rose at 3.4% annualized. Now, that's the biggest gain in a year. Consumer spending increased 2.5%, which is a good thing, but it is down 3.3%. And it's below the estimate of 3%. Let's get to the good stuff here. So Meta Platforms, this morning, the low, $414.50 is now trading at $442. It's only down about 10.5%. So it's holding that $1 trillion market cap at $1.12 trillion. PE ratio, this is going to be 12 months trailing on Google, 25.46. This is for Meta Platforms. And a reminder, if you weren't aware, this does pay a dividend now. It's about 0.45% dividend yield. Now, earnings were pretty good. Beat on the top and bottom lines. You can see Q1 GAAP EPS, $4.71. That beat by 39 cents. Solid. Revenue, $36.46 billion. That's up 27.3% year over year. Very solid there. Beat by 240 million. So what's the problem here? We just saw Tesla, who didn't give us a good earnings report at all, and the stock is green, yet Meta's selling off. Well, I talked about Tesla in a recent video, so I won't spend a lot of time, but that really comes down to investors being excited again about the $25,000 car and then the robotaxi announcement in August. The sell-off on Meta comes down to comments on the earnings call from CEO Mark Zuckerberg. He discussed spending money in areas like artificial intelligence, so more CapEx spending. Now, if you remember, the reason why Meta sold off hard in the first place is they started spending a ton of money and they told us they were going to pivot to Metaverse, of course, changing the name from Facebook to Meta Platforms. So we just had earnings reports from Tesla and Meta, and both companies told us they're spending more money on artificial intelligence. Now, AI is not profitable for these companies at this point. So this is about the future. Wall Street cares about right now. The one thing that was very obvious, and I told the gang in Discord this morning before the market opens, companies like Tesla and Meta that are spending money bulking up on AI, Wall Street's not going to like that quite as much. But who are the beneficiaries right now? Well, it's going to be companies like NVDA. NVIDIA is benefiting from AI right now. So if companies like Meta are going to spend more money building up data centers in artificial intelligence, well, the companies that are going to benefit right now are going to be NVIDIA, other semiconductor names, of course, fabric companies like Broadcom. You've got SMCI. Of course, SMCI is not a semiconductor company, but if you're building more data centers, you're going to need more racks and hardware, and that's what SMCI is all about. So those are the beneficiaries, really the phase one of artificial intelligence growth. And this is a quote directly from Zuck. I think it's worth calling out that we've historically seen a lot of volatility in our stock during this phase of our product playbook when we're investing in scaling a new product but aren't monetizing it yet. He's admitting that they're not making money off of AI yet. And he cited past efforts which ended up working out well for him, like Reels and Stories in the transition to mobile. So at the end of the day, Meta Platforms right now, it's an advertising company. They're making their money off of ads. The company is very profitable and it's doing well. And I'll admit, from someone that's used advertising from both Google and Facebook, Facebook is really easy for small businesses to use. I personally don't really like Facebook and I don't really like Instagram. I get every hour, every 2 hours, I get a random bot message in those platforms and it's crazy annoying. Now, of course, something like Metaverse and AI could be huge for Facebook. And the thing about it, this company has the benefit of being profitable, making money, stacking cash, paying a dividend while it's chasing after some of those moonshots. And it's not crazy expensive even at these prices. I recently made a top 25 high conviction stock pick video, and Meta wasn't on that list, but I did include it as a bonus pick on my watch list. It's something I currently don't own, but I think if Meta could monetize AI with the new LLM, I think that could be game changing for Meta moving forward. So for me personally, I don't think it's a terrible buy where it's at now. I probably wouldn't buy it unless it's under $400 a share. And that might not happen. This next one is sure to get your blood going. Enphase. Enphase, a miss on the top and the bottom, also weak guidance. Q1 non-GAAP EPS, 35 cents, missed by 4 cents. Revenue, 263.34 million, negative 63.7% year over year. Bruh. Misses by 14.23 million. There are some positives that I'll get to here in a second. One thing I want to make sure I point out, as part of our $1 billion share repurchase program, Enphase repurchased 332,735 shares of common stock, average price $126.21. And now the stock's $107.47 after hours. So not really the best buys. You know, the stock actually got down to $73.49, 52-week low, 52-week high, $192.22. Now, the PE ratio is still high, 56.5, market cap, 14.66 billion. Now, the earnings call was ridiculously long, and I kind of regretted listening to the whole thing. I'm bringing you the quick highlights here. Talked about several new offerings. Europe is doing pretty well. And looking further ahead, the company still has this vision where they can offer complete home energy systems, not just the microinverters and the batteries. This will include home energy management software, mobile apps, even bi-directional electric vehicle chargers. So they're trying to increase what they call share of wallet per customer from about $2,000 to closer to $12,000 or even more. We've talked about this on the channel several times, and I've done several Enphase videos telling you this. Higher interest rates are bad news for companies like Enphase. If you think about what Enphase is doing, it's going to have to sell to customers. Think of a homeowner. I'm a homeowner, and I'm going to spend money to put solar panels on my roof. I'm probably going to finance that. If rates are a lot higher, it's going to be more expensive, and that's going to offset the potential savings from the electricity costs. So the lower rates are really going to help a company like Enphase. Of course, what we know is that interest rates are going to be higher for longer. Beginning of this year, the market thought the Fed was going to cut rates 6 times. Now people are saying 3 times, and that's optimistic. Many are saying 2, 1, or even 0. So higher rates for longer is going to continue to put pressure on Enphase. Now the market is forward looking, and the market wants to look forward because there is potential with this company. And I think the growth is improving. There's a chance that this could be the bottom for Enphase, but I think that's being optimistic. And I think if you're buying this stock at 55 PE ratio, there's some speculation built into that. I've said before, if you buy this holding it for 5 years, it's probably going to work out because interest rates should come down, of course, in that period. So there's a chance this could have another bad earnings report and sell off again. The stock actually got down below $100 this morning, and my new target really for this is the DCA under $100 a share. I'm going to be patient on it. I'm not going to rush to buy any more shares. I believe my cost basis is something around $115, so I'm doing okay, and I have plenty of room to add more shares.
We beat on the top line, we beat on the bottom line, and we raised our full year guidance.
Well, Bill, that's because you're the man, and ServiceNow is one of my highest conviction stocks. It's benefiting from AI right now, and it's going to continue to do so.
And we can all debate that I increased the guide enough, but that seems to be a pretty high-class problem because, you know, ServiceNow has become the AI platform for business transformation, and we're proving that. You know, the number one Gen AI use case in the world today is process optimization. So, Jim, in terms of things being fine, think about every business workflow and every enterprise around the world is going to be engineered with Gen AI at its core, and we are that single pane of glass that's going to drive that transformation.
You heard it directly from the CEO, and this was a solid quarter. Of course, the stock isn't necessarily cheap, and it's had a nice run. You look at this, though, a beat on the top and bottom lines. This is a profitable SaaS company with recurring revenue, showing a forward PE ratio here on Seeking Alpha of 57. Looking at SaaS-specific metrics, that EV NCM revenue, it's rocking about a 12x right now. Free cash flow, one of the best names in the business at 30%. In the rule of 40, you want that 40% or higher? 56%. So I'm bullish on ServiceNow. The ticker is NOW now. I just did a top 25 high conviction stock picks video, and it was on the list. Hot off the presses, Microsoft earnings are out. Headline, Microsoft's cloud growth accelerates on back of AI push. So up 5% after hours, one of my highest conviction stocks as well. Earnings per share, $2.94 versus $2.82. Revenue, $61.86 billion versus $60.8 billion expected. Total revenue grew 17% year over year in the quarter. Strong numbers here on net income. And then looking at the intelligent cloud segment, including Azure public cloud. So we talk about the public cloud services. It also includes Windows Server and GitHub, produced $26.71 billion in the quarter. That's up 21%, and it's higher than the $26.26 billion consensus. Revenue from Azure and other cloud services grew 31% compared to 30% in the previous quarter. Expectations were 28.8%. That's the CNBC, and then the street account consensus, 28.6%. So solid beats across the board. Personal computing revenue totaled $15.58 billion. That includes Windows operating system, Surface PCs, video games, and search, up 18%, and above the estimates. The consensus here is $15.08 billion. We got about $500 million higher. Revenue from Xbox content and services was up 62%, thanks to a bump from the $70 billion acquisition in October, Activision Blizzard. And of course, Microsoft also owns Bethesda Studios, and you know the hot new series on Amazon is Fallout. Certainly not a cheap stock by any means. 36 going on 37 PE ratio, about a $3 trillion market cap. It does pay a dividend, so this is a DGIF company, so not a cheap stock at a 36 PE ratio, sitting around a $3 trillion market cap. Does pay a dividend, so this is a DGIF stock, about 0.75%. Now, the 52-week high was $430.82. 52-week low, $292.73. After hours here, it's trading at $418.20. So NVIDIA is my top holding, long since 2017. Microsoft is my second highest position, long since 2012. Alphabet, Google earnings are also out. I'll cover that next. Now, in this video, I've talked about a top 25 high conviction stocks video that came out on Sunday. In fact, it has 32 stock picks. I've got some bonus picks on there. You can go watch that video absolutely free. Go to patreon.com/firedupwealth. There's a 1-week free trial to Elite. That'll let you watch that video as well as many other videos, hundreds of hours of content, and get access to Discord to check it out. Invest in yourself. Be a better investor. Give us a try. You will not regret it. Well, I've been looking for more dividend stocks. I already own one. Alphabet shares jumped 14% on earnings beat. First ever dividend. Another stock that's on that top 25 high conviction stock pick list. Earnings per share, $1.89 versus $1.51. Strong beat. Revenue also a beat, $80.54 billion versus $78.59 billion. YouTube advertising. Well, you know there's an ad. It seems like every couple minutes when you're watching a video. I can't even control it. It's going to beat $8.09 billion versus $7.72 billion. Just a quick comment on that. I have a barbecue channel and it's not even monetized, and they throw up ads on that thing all the time. I think that's kind of annoying. I can't even turn it off. Google Cloud revenue also a beat, $9.57 billion versus $9.35 billion expected. So both Azure and Google Cloud Platform beat. Are you surprised? If you're in Fired Up Wealth, you're not. The TAC also a beat, $12.95 billion versus $12.74 billion. So a 15% increase in revenue, a cash dividend of 20 cents per share to be paid on June 17th. We've been talking about this for about a year, saying at some point, Google, probably even Amazon, they're going to pay a dividend. Meta just recently announced a dividend last quarter. That was in February. And now you've got Alphabet. And part of the thing is, you know, Department of Justice, they're not going to let these big mega cap tech companies buy anything. So they got to do something with the cash. They're trying to be more shareholder friendly. This is a good thing. Essentially, it'll be a DGIF stock with time. The board also authorized an additional $70 billion of shares. This is big. And Alphabet's sitting on cash and cash equivalents of $108 billion. That's down from $110.9 billion. But $108 billion in cash. These mega cap tech companies are absolutely just crushing it. Net income jumped 57%. Ad sales, $61.66 billion, up from $54.55 billion just a year ago. Companies also investing heavily in artificial intelligence and generative AI. Tons of secular growth trends that you can capture by owning a stock like Alphabet. Now, this is going to be sitting over a $2 trillion market cap with the 14% pop after hours. Hard to say if that holds up, but really strong pop here. The PE ratio will be over a 30 with this move. 52-week high, 160.22. Well, now after hours, it's $177. 52-week low, 102.63. If you want to be a better investor and content like this is helpful to you, make sure you subscribe to the channel and click that bell for notifications. And if you want to return the favor and this video is helpful to you, drop me a like, drop me a comment. Thanks for watching. Have a great rest of your day. Take care.